So welcome one, welcome all, welcome to anyone who has gathered upon this video today seeking some clarity and direction when it comes to market trading. I hope I live up to your expectations and provide you with some premium content plus some premium value. That's going to be my job, and man, is that going to be a big task, but I'm up for the challenge, so I hope you stick around. I shall greet all of you. My name is Doug. If this is the first time you're ever visiting this channel, welcome. I'm with Trade with Doug, and I will always greet everyone with the official hashtag Joyant, the official hashtag Jubilant, the official damn, this bear market be going on forever and ever. Seems like it's never going to last. In fact, it's one of the longest since 1923. Was the market even open in 1923? We're going to talk about that. We got a lot of stuff we're going to talk about. When will this market stop? Where can we expect a turnaround? Where are we in history? Because we've got some startling stats. And did Mr. Powell say last week, you should be selling more of your stocks? I think he did, and we're going to talk about that. Now, before I get started, let me go back to something else. I just want to spend 1 minute. Sorry for having to do this. I know many of you out there are hurting and you're inconsistent with your trading. I know what you're going through. The market's up and down. Many of you were making money. Market was a lot easier to trade. Now it has changed. I want to go back and talk about this part-time trader. I haven't done that in a month. I talked about it while the market was down 8%, this being up 24%. We're up another 24% in the last month. You can see this. While the market has declined an additional 12%, 13%, somewhere in the neighborhood like that. Again, the market's down 20% for the year. Look at this, all green this month so far, up another 24, 25% since then. Now, here's what I want to talk about, because it's not all about my gains. What this is about you. The part-time trader program is a theory where less is more. You're not trading every single day of the week. You're only making 3, 5 trades a month, or whenever setups present themselves. So you'll see sometimes there's a lot of activity because there's a lot of trades. Other times there's not a lot of trades. But the point is to take advantage of stocks before they break out, before they break down, before everybody is changing them. So if you don't have a lot of time to look at a computer, you're just looking for a couple of great actionable ideas, and because it's a swing trading program and you can hold these for a few days, the entry isn't that spectacular. You don't have to get in it right away. If you're looking for a couple of quality trade ideas, do it. I'm doing a special again. I'm reactivating the special that I was never going to do again. It's $150 a quarter, $400 a year, or $450 a year. That's pennies on the dollar for what you're getting. So let's move on. Let's talk about a few things that I want to highlight today. And I want to talk about the Fed here and what I mentioned in the thumbnail. Did they pretty much guarantee us a market crash or a correction? So a few notes from the meeting that we had a couple days of testimony from Powell. He said that we'll continue to raise interest rates until inflation gets under control and reaches key levels. And basically saying that doesn't matter how aggressive they need to be, is exactly how aggressive they are going to be. Now, some of you newer traders might not understand what that lingo means under the surface, or at least how I am translating it at this current moment. If you go back in the history of Jerome Powell's tenure as Fed chairman, he's always been somewhat of a puppet to the market. Whenever the market has asked for something, he's caved in. He tried to do this whole rate thing years and years ago, but crumbled under the pressure of Trump and other market powers, and off we went with the rally. This time he's not budging, which makes me feel that it's worse, way worse than what the numbers are saying. Now, strangely here, I find this kind of comical. It's been good to see financial markets react. Financial markets have been going down the toilet. What is he so happy about? Now, my conspiracy theorist mind would say, if you guys can remember, the Fed was able to trade stocks. How easy is that, right? They were able to trade stocks up until a couple of months ago. Then they start putting these policies in effect when they can. So now they're happy. I guess the politicians are happy to buy this dip whenever the time is ready. Also, I think what else is interesting is it feeling some pain as they raise interest rates, saying we're not going to get a soft landing, feeling some pain. Have you ever been to the doctor's office and they look at you and say, I'm going to snap this back into place, or I'm going to do this procedure? You may feel some pain. What does that normally mean? Some pain in my ass. You mean torture, right? You mean torture. I think this is going to be a lot worse. A couple other notes. Um, that they should have raised, admitting now they should have raised rates last year, which I agree with. So what we really have from this speech is the Fed's going to stay aggressive on tapering and interest rates. Regardless of what the market does, their sole means is to control inflation, is to get that under control, first and foremost. Whatever that takes, if it even takes more raising, more aggressiveness, that's exactly what they're going to do. If industries and businesses suffer, they're okay with that now. They don't want that to happen according to them, but they're okay with it. So that's the Fed's main priority, is to get inflation under control. Because we've gone so long with low rates, who knows how bad this might be or how much froth may still come out of the market. This is something I've been talking about. So for those who are looking at when will you see a bottom, well, you're always going to get speculative money put to work. We'll talk about charts in just a second. But consistent rallies, I don't see that happening until inflation gets under control. To give you an idea of where we really are, I took this from CNN Business. This is, let me make sure I read this right, 8 straight weekly loss, the longest since 1923. 1923 that we've had this many consistent red weeks. Now I want to go back and again say, guys, if you're new to trading, people told you to prepare for this, to learn how to trade, to understand market corrections. I wasn't born in 1923. I know I'm old. I wasn't trading back then. I've been trading for a while, but not that long. I didn't realize that's how long this thing has gone. That's pretty aggressive. That's pretty deep. And it appears as if the worst may not be behind us. And why is that? It's because of those interest rates. So what has happened here in a roundabout way, in layman's terms for each and every one of you? When money is free in the system where it's easy to borrow, qualifications to get it is lower. It creates inflationary environments, right? Nothing ever changes. People shop payments. So if you look at real estate, they don't shop necessarily the price of the home. They shop the payment. You're paying $2,000 a month now. What would $2,000 a month buy you? $2,000 a month in a low interest rate environment? Maybe a $500,000 house, maybe a $600,000 house. Again, you're shopping payment. High interest rates? Well, you can't pay that. That same $500,000 house might be $2,700 a month, $3,000 a month. So the only way you can get buyers is the real estate prices must come back down and balance themselves out. Very same thing that the market is going through with the Fed's intervention, easy money, lightening monetary policy, QE, all of that stuff injected liquidity into the market. Companies were able to borrow. They were able to do buybacks. You pull that out of the market doesn't know what is it supposed to be when it's disconnected from life support. Now, eventually it will find a bottom, but still, like I said last week, the week before, we haven't got that yet. Price action, charting, all of these techniques you guys learn, it will tell you when you're ready. So if we kind of move to a weekly chart here, let's take a look at some other zones. I felt we would probably find a stopping point in between 20 and 30%. Now, that's a big gap. That's between 3,900 and 3,400. So that's no small change right there. Friday, selling off aggressively. You get a late day bounce. We'll talk about that in a second, but you're just a shade over 20%. There's some areas here of interest, and there is this pre-COVID. I feel pre-COVID is a good place for all of us to start, and that puts us at about 30%. I say that because we could assume that many companies, which we'll show charts in a second, for example, Roku, PayPal, Netflix, Facebook maybe, I don't know the exact number, but many of these companies, growth stocks, and some FANG stocks, have given back all of their post-COVID rally. Not from the very bottom, but their pre-COVID levels where they were, many of them have traded back to that. That's sort of like a complete wash, like the market just gave it all back. All of that rally was just falsified, fake, frothy, whatever you want to call it. There's a possibility that that's exactly where we end up landing. So still, there isn't any reason yet to go long. I know you saw a pretty stout rally towards the end of the session. This could just be algos, could be just speculation, but don't get caught up. Again, that's the only advice I can give you, because I'm not going to be the one that says, oh, this is where we're going. Oh, historically. Remember, history is just a benchmark. It's not a guarantee for us. What we witnessed is a first time in history event. COVID, first time in history the world's been involved in a pandemic since the Spanish flu, the whole world. I know we've had other pandemics, but this involved everybody. The Fed had never cut so quickly, had never QE'd so aggressively. So what's to say that we can't drop more aggressively, that we can't drop longer, that it can't be more painful than expected? We have to prepare. And what we've seen lately is there have been attempted rallies, but they've only lasted about 2 days. So yeah, you could get a bounce back up to 4K here. This could continue on Monday, but I encourage all of you, do not be fooled by the instant V-shaped rally. That's going to happen. We'll see it. There's plenty of room. I don't believe we're even going to scratch the surface of all-time highs again this year, but there will be rallies. You're just in a different environment. Every 10 to 15 years, the market goes through a deep 20 to 30% correction. It's all part of the cycle. We will come through this. All storms shall pass. But for the immediate future, this is what we're seeing. Now, something else I want to bring up to your attention, since I haven't mentioned individual names. There's some unique things that are happening. I shouldn't say unique. We're looking at previous beatdowns. Let's start with something like a Roku. While this market's been continually correcting, it appears like this hasn't done anything for the last few weeks. It's actually held up quite well, considering it's down, I don't know, 70% since last year. You have something like Shopify, former growth stock, kind of the same pattern, holding steady. Here's PayPal. Let's get a few IPL. Same thing, looking pretty decent here, actually. And let me see if I can, there's a bunch of them. Spot. I'm just going through these real quick if you guys want to jot down these names. I'm sure you have. Just pick a growth stock. They're all going to look the same. They're going to look like death warmed over from November straight down. And they're finding a little pocket here of stopping. While the market's still finding lows, while we were really getting beat up really badly on Friday midday, these were holding up relatively well. Let me see if Square could be in there. Yeah, Square. Here's another one. Pick your poison. Pick your poison. All I'm saying is this. I'll go back to Roku and keep that one for the ease of the example. It appears as if money is moving out of your staple names. If you go back to a couple of videos I was talking about a while ago, you had Tesla, Apple, Microsoft, Google. They were holding up the market while everyone else was taking a dive. Now those are taking a dive. And it seems like the ones that have already been beaten up and left for dead, the old growth names, seem to be getting a little bit of spec money. I wouldn't call it any more than spec money, maybe putting some money to work over here for a potential bounce. But there's some relative strength to where they're holding up a little stronger than normal considering their high beta. They're holding up pretty good. If you have a list of these, watch them, because if the market does rally, I think you're going to see some pretty potent moves in this. Adobe's another one. Oracle, another one. Qualcomm, I'm just running some off the top of my head. Again, pick your poison. It won't be hard to find one of these. That's something I'm find interesting, excuse me. This could mean that maybe the end of this sell-off is near, that it's just finally taking out the big names, and then once we get all that washed out, then maybe it's back to business as usual. We could start seeing something at least a little less volatile, a little more consistent in its movements, because I know for some of you, it's just up and down, up and down, up and down, all over the place. So keep that in mind. Build you up that list of those old names. If you need some more of them, just shoot me an email, support@thelincolnlist.com. I'll do my best to try to come up with what I have on my list. But we talk about those again. It could be DEC, Crowd, Adobe, Netflix, Facebook, Wayfair, Spot, Starbucks, Qualcomm, Cliff, CLF, Teradyne, TER, a bunch of those other ones. ACOM Technologies, PayPal, Chewy, anything, all those growth stocks. And again, the reason they're down, guys, so much is because that money is gone. It's harder for them to borrow money. It's harder for them to do stock buybacks. It's harder for them to raise capital. Many of those companies are not quite profitable yet. And that's what a growth stock is. It's not necessarily profitable, but it has a lot of upside potential. It's harder to grow in a high inflation environment. Makes complete sense. And there's really no safe haven here. Something else Powell had said that just popped in my mind, sorry for bouncing around, that none of this looks like it's going to stop until we get into this Russia-Ukraine that's putting a lot of pressure on commodities. So guys, we're going to be in this for a little while. There will be trades to make, but this is where your technical analysis and your years of training have come in, because unfortunately, so many people have blown up by being stubborn. And I know what that's like, because this is the same mistake I made in the year of 2001. Same mistake. Being ignorant towards the depth of correction. Randomly buying dips because everything just bounced. Stonks always go up. We had that same theory back then. We just didn't use the word stonks. We didn't have memes. But it was the same thing. I still hear those echoes. Can't be like that, guys. If you want to make money, you got to be serious about making money. You got to be prepared for all these scenarios, because look, it doesn't take long. I know a lot of people were talking about a bear market and they sounded foolish and stupid. I'm talking about that for years and years, and it gets dull and it gets boring and irritating to hear. But in just 4 months' time, look what's happened. All the coiners, all the meme stockers, all the growth stockholders, look how much damage, and I showed you in last week's chart. More money has been removed in wealth in this correction than any other in the history. That's massive, guys. This is no frickin' joke. Anyway, hope you learned something here. Moral of all of this here, we're going to look back. Can't tell you where the bottom of the market's going to be. Maybe we start out the week with a little continuation. Don't buy into any rally. Just trade it for right now. Keep an eye on growth stocks. This looks like the beginning stages of some money trying to come back in there. And if the market rallies, I would probably nibble on a few of these with a mild size position. But other than that, you just got to hang on and keep doing what you do. It's day by day, trade by trade, and you'll get to where you need to go. Other than that, guys, take care. Trade well. I'll talk to you soon. Cheers.